If you're just starting out and trying to figure out what can I do to get some real estate in my portfolio, I'm not sure what to do, this episode is going to be perfect for you. So then we're going to go through all the ways you can do it, because really most of the stuff we've talked about so far, it's just been, stories about active investing that we're doing, or how you can invest, just deal by deal passively, but there are other ways to invest.
I'm Drew Breneman, and this is the Rise and Invest podcast. I bought my first 2 properties as a 19-year-old with my own money that I earned from an online business I started in high school. I've now grown my portfolio from that first duplex to hundreds of millions of dollars of investment property. My goal with this show is to give you the resource I wanted when I first started out. Subscribe to our podcast where I break down real-life stories, tactics, strategies, and current market information you need to be a successful investor.
This is the Rise and Invest podcast. I'm Drew Breneman, back today with another episode. Today's episode is going to be about the different ways you can invest in real estate. And I think before I jump into that, just want to mention we've rebranded our company from Rise Invest to Breneman Capital. So we just wanted to do a brand refresh. And originally we were using the name Breneman, just wanted to go back to it. So check out our new website, breneman.com. So B as in boy, RENEMAN.com. So same team, same strategy, same everything, just new name. So with that out of the way, just wanted to, want to point out, I guess if you're watching, this is a little different setup than usual, just shooting this kind of quickly in my office here. And just wanted to do something maybe a little more simple and break down the how you can invest in real estate, what the different ways are. Maybe this is more of like a beginner episode, I'd say, where, if you're already like a real estate professional and in real estate, there's not, I don't know how much you're going to take away from this, but if you're just starting out and trying to figure out what can I do to get some real estate in my portfolio, I'm not sure what to do, this episode is going to be perfect for you. So then we're going to go through all the ways you can do it, because really most of the stuff we've talked about so far, it's just been, stories about active investing that we're doing, or how you can invest, just deal by deal passively, but there are other ways to invest. So I guess before I run through every way, actually I think it'd make more sense, I'll just mention the 5 ways as I see it, and then kind of how I think about it. So really, like, the first way you can do it is just active investing, just buying a deal on your own or with a partner. And then that's, probably the most common way you hear about, just someone buys a duplex on their own, or with like a buddy. And then there's other ways too. So you can invest in public REIT stocks. You can invest in a deal directly through a syndication. That's what we do. So we find the deal, and then people invest in it. And then also similar to that, there's 2 other options. There's real estate funds. So same similar concept. I'll get into the differences, pros and cons later. And then also there's non-traded REITs. So all the 3 of those last ones, they don't have any, or really all 4 of those last ones, they don't have any day-to-day involvement. So that's kind of where, like, I think, like, starting to think about like what investment would be right for me, or for you listening and watching. Really, like, how active do you want to be with this investment? And, and with that, like, how much control and availability do I want to have with, like, my life? So if you're, I'd answer that for yourself. If you say, yeah, I'm fine starting a part-time business essentially, and I like to have full control of every decision, and then that's going to dictate what you want to do. If, let's say, you're heading towards retirement and I don't want to take on more work. I just want to make some money and diversify my portfolio with something that's not correlated with the stock market, like, then that's going to dictate what you want to do. And then from there, like, I'd say I really would think about, like, what's your investment horizon, and what are your liquidity needs from a timing standpoint. So, like, if you need the same liquidity as the stock market, that's going to change what you can invest in. Whereas if you're okay with a longer investment horizon, let's say you're okay investing money in things where you're not able to tap into that for, let's say, 3 to 10 years, then that's gonna open up what you can invest in. So really, I think answering those things is how I would start, and then from there, that's going to sort of just dictate what option is going to be best for you. So I guess to kind of go through the list here, and a lot of this is actually from our passive investing guidebook too. This is a much longer form version than what's in the guidebook. But if you're interested in these kind of topics, you can go to breneman.com/downloads. We have a 100-page book on all the different pieces of investing in real estate, different terms, a glossary, things like this. We touch on each way in the guidebook. So you could read this for yourself later if you'd like. And this is just a longer form version of that where I can read it too and then explain it. But really, so like, let's start with the first thing you could invest in. This is what we do, are direct investments on a deal by deal basis. So also everyone calls those syndications. So what those are, that's when a group of individuals or firms, they aggregate capital for the purpose of investing in real estate with direct ownership in the property. This is often done with a sponsor or general partner that acts as the point of contact and handles the day-to-day management and operations. In this model, outside investors contribute capital to the partnership in exchange for interest in the entity as limited partners. And then everyone calls limited partners LPs. So you have your sponsor or general partner, which everyone calls the GP, and then the investors, it's called LPs. And on these deals, the cash from operations or capital events like a sale or refinance, those flow through the partnership to the GPs and LPs. And so what's really nice with these, with this setup for the LPs, is that you get to review the deal prior to investing in it. There's other options we'll get into where they're also passive, but you don't have a say in what your money is going into. Where on, let's say I mentioned REITs or the funds, like they don't check with you as a shareholder, as someone who invested in the fund, like, can we buy this deal or not? They have a strategy they laid out on those other options, and then as long as it follows that, they're not going to check with you on it. So one real benefit to syndications and direct investing deal by deal is you as the investor, you can decide how you want to approach that deal. You could look at it and go, timing's great for me. I have extra money from something right now, and I'm okay with this hold period they're talking about, and I really like the deal. You can choose to invest more than in that deal, and then because you have a high conviction in it. And then on the flip side, if you look at it and go, you know what, this deal's not for me. I really want to do apartments, and then they're buying a car wash or something different, or just some strategy I don't know that much about, and I want to sit out, or maybe they're going to buy an office building or something, and you go, you can choose to say I'm out on this one. So that's a major benefit in my mind. Obviously, like one thing that's nice with I'd say one of the negatives I could think of with the deal by deal investing is that takes more work. Now, instead of if it's just like investing in a stock or in a fund where you put your money in and then you're just going to be in every deal they do, this now, if that sort of ability to choose the deal that you want to invest in and how much, if that was not appealing, then that's actually going to turn into a negative, because now you have to be paying attention and reviewing the deals, and then deciding how much to put in, sending your money in separately for every deal. Whereas if, let's say, you just wanted to invest, $200,000 in real estate and you put it in a fund, you just send it in once. Where instead, if you're going to do that, it'd be smart to spread that out over 4 deals, let's say, and put $50,000 in each. So then you got to do the same thing 4 times. You got to wait for a deal to come out. You got to wire in your money. So that's really the main, let's say, negative I could think of in terms of for that setup. But it's a great way to invest in real estate. You get the tax benefits as an owner of the property are shared with you. So those flow through to every owner in the deal, including yourself as a LP. So I think that that pretty much covers that. So then I'd say the next way I see people investing in real estate, it's another passive way to invest, and that's the real estate funds I was touching on. So funds have similarities to syndications, but ultimately they're different. The structure is generally the same, but there's an additional layer of ownership. Additional special purpose entities are created for each new acquisition, serving to shield the fund from liabilities arising from individual properties. And then the fund can either invest alongside operators, let's say, investing in other people's deals. So then that's going to add another layer of ownership, or they might be the sole operator and just the fund will be the direct owner. And usually funds, or really every fund, I should say, they have a predetermined scope of what they invest in. So it's not just like I give the person running the fund money and then they can just buy anything. Like there will be a predetermined scope and framework for what kind of deals they can buy. What's the leverage amount going to be? Leverage amount. So what would be their loan to value on each purchase? Like that'll be all dictated in there, and also the fund life. So it'll say like this is a 5-year fund, or 7 years, or 7-year with the ability to extend up to 3 years if the manager wants to. Those are always going to be set out. So if that matches with what you really want to do, where I want to have this for 5 to 7 years, let's say, and I like their strategy, and odds are I just invest the same amount in every deal anyways, and I don't want to have to invest in all these deals one by one, like then a fund would be a good option for you. The downside of investing in a fund is that you're not able to decide deal by deal. So let's say there's just some, I don't know, like you're more interested in investing in a certain state than others, and this company that has the fund invests in a bunch of states. You're not going to have the ability to say, oh, I want to sit out all the, let's pick on a state, all the I'm from Wisconsin, so I want to sit out all the Wisconsin deals. I don't, you're not going to have that ability. If that's where the fund can invest in the Midwest, and they pick this Wisconsin deal, you're in it. And then they don't check with you. They don't need to run it by you. What do you think of this deal? You've invested in the fund for their expertise and knowledge, and so they're going to proceed without checking with you. So that's the the main downside, I'd say, is just not having that ability to kind of veto things one by one. But you do get really good diversification. Let's say that fund buys 20 properties, and you were in that example I had investing $200,000. So you're getting more diversification through the fund than through the one-off deal. In that, odds. I think most people who invest in the deals deal by deal, they like, knowing what their money's going into for sure, and then deciding. And then also, they can. Might like different deals that have different timelines. So let's say the fund, it says you're going to get all your money back in 5 years. Whereas if you're doing it deal by deal, you could say, oh, I'll invest in this deal that's a 3-year hold. This one's a 5, this one's a 10, and then kind of spread out when you're going to get your money back. So I think that's like also a plus of the direct investing, the syndications versus a fund. But yeah, funds are great for diversification and doing the least amount of work for, like, say, private real estate. So then the third way to invest in private real estate passively is through non-traded REITs. So really, like what these are is, it's similar to like a REIT as you would think of like a REIT stock, where you're buying units in a company similar to a fund, and you're going to get that diversification across multiple properties. The benefit, let's say, to the non-traded REIT is there is going to be a liquidity option. So the REIT you'll be able to sell your REIT shares, and they'll do some sort of valuation whenever the predetermined exit points are, whether that's going to be quarterly or semi-annually or annually. Non-traded REITs, though, they get a really bad rap, and for good reason. Like the whole industry is pretty controversial, almost because the fees generally on all these are really high. It's common for investors to pay a 10% load to the person selling them essentially this investment. So let's say you're investing, $1, only 90 cents of that is going into the actual investment if you're paying that kind of fee to get in. So then you have to make an 11% return just to get back to zero on that. And then the fees are not cheap as you go year to year, the asset management fees. And then, I think a lot of these, when you have a point where you can exit, so where you do have that liquidity option quarterly or annually or whatever, the valuation is not to me like clear how that's coming up, where it's nice in these other deals, like with a fund or the syndications, like they actually sell the property. So you got the best price for your building and for your units of what your investment's holding, because you actually sold it to the highest bidder. Where this, you're going to get some sort of private valuation that maybe has a discount applied to it. So non-traded REITs are something that would you might hear if you're looking to invest in the private real estate market. And and you're looking for like a liquidity option, but I would definitely recommend investing in a deal directly or in a regular real estate fund over a non-traded REIT. So, and then sort of lastly, another option, and really the only one if you want liquidity, is really investing in public market REITs. So REITs are companies that own and operate or finance income producing properties. And these are think of them as just stocks. They're all traded on the New York Stock Exchange or whatever stock exchange they're on. And they're essentially stocks, and what they own are buildings that produce income. So the company is an Apple or Microsoft or something. The company is just a collection of income producing properties. So then what's nice with that is you have, every day the stock market's open, you have full liquidity. You can sell them at any point. I mean, some people almost that's one of the reasons they like real estate investing in the private markets is they can't do that. They can't panic sell, or they can't, they need to see the business plan out. Like the market gets choppy, and then in the stock market, you're looking at your screen every day for a value, and then you have to hit the sell button at the low of the market. So some people actually, they view almost the illiquidity in some of these private real estate deals as like a plus, because then it prevents them from making like a emotional decision. I still think obviously like having liquidity is better than not. So for me, if I could, I'd love to, be able to time the markets more. It's just not how real estate works. So, I guess kind of REITs. So it's great for the liquidity. And then they buy really high quality properties. And so that's, they're generally less risky. And they also use pretty low leverage. A lot of times you hear about REITs buying a property and they're putting 50% down and then only borrowing like another 50%. Which, most private buyers, I'd say they're in the 65 to 75% LTV range. So a lot of funds or one-off deals will be done like that. Probably funds a little lower LTV, but especially those one-off deals, pretty common to see 70, 75% LTV. And then, so like that's a plus with them being less risky, obviously, but anything that has less risk then lower reward. So the returns on REITs, generally they haven't been as high as what we've seen in the private markets. We went back and compared it and ran the numbers. And they need to distribute a minimum of 90% of their taxable income to shareholders. So they're not really keeping much cash. Like they don't, they just, whatever they get, they pay out. So you're not getting, there's not like, if you are, let's say, are an owner on your own, maybe you take that money and you're going to be putting it towards another property or doing something at the property. But generally they take in the money, they pay it out. So, but on the flip side, there is a dividend then that's usually pretty healthy. But again, since they're lower leverage, lower risk properties, it's going to be a lower dividend than what the cash flow would have been on a lot of these private market deals. Again, this is all just kind of generalizing. I'm sure there's some REITs that are out there that invest in something that pay more cash flow than some private market deals. But generally speaking, this is how these things work. And then I'd say, but the main negative with REITs is that they're really correlated with the public markets. They're in the public markets. The returns of a lot of these REITs are really highly correlated with the S&P 500. We ran the actual numbers, so that's in our guidebook. I don't have that in front of me, but the correlation was really high. And the correlation with private real estate, the NCREIF index, which is the closest thing we got to a index showing where private real estate values are, had very little correlation with the S&P 500. And to me, like that's why to invest in real estate, like it when your stocks go down, it doesn't mean your real estate's going down. It obviously could, but it's not. It's moving for different reasons, and they move differently. And that's, at a certain point, you don't want all your investments doing the same thing. So like that to me is the main negative of REITs, where you got that high correlation to the S&P 500, and then you got these high frequency traders or hedge funds or whatever they'd be called, where they have algorithms. They know, okay, usually when there's a recession and interest rates are going up, that puts a lot of pressure on real estate. So then at a time like now, we're shooting this podcast in late 2022, like the REITs will be oversold to the point where the total value of the REIT will be will be less than the value of all the assets if they sold them on the private market. So if you just added up the price of every apartment building this apartment REIT owns, then the whole company on the New York Stock Exchange or wherever it's trading is worth less than the actual assets. So that's this is not what this episode is about, but look out for like Blackstone and some of these bigger groups that have a lot of money to put out on taking REITs private, because they're going to be undervalued. So maybe as a short-term play, if you wanted to gamble on that, that might make sense. But I don't think that's why anybody's in REITs to just be bought out by Blackstone. Maybe if you're trading at a discount to your private market net asset value. But anyways, that's REITs. And then really the last way to invest in property is on your own actively. So active real estate, that's investing in individual properties yourself or as a group with a partner, and you own the property outright. So unless you hire a company for accounting and property management and other things, you're doing all the work. This is how I started out. I bought my first deal. I did all the work to find it, to finance it. I guaranteed the loan. I was the property manager. I was the accountant. I was the snow shoveler. I did everything. I was the maintenance dispatch center. I guess I didn't know how to fix everything, but everything came through me. It was a part-time job. The whole time that I had, it's been a part-time or full-time job since I was 19 and bought that first property. So if you have the time and interest to do that, it is a great way to invest in property. So you have full control over your investment. You can sell at any point. So, when I said the funds and other things call it think of it as a 3 to 10 year time horizon. If you own the deal yourself, you can determine what the time horizon is. You can hold it for longer than 10 years if you want, or if you really need to sell, you can sell it quicker. The transaction costs are so high in real estate that will just never really make any sense to just buy something and own it for like 6 months and then sell. Unless it's been, maybe if you bought something in a certain place right before COVID and everybody moved there, you could sell and make a crazy return in a year. But normally that's never the case. So that's not really, but you do control it. So you have full control of whatever decisions are being made. You're not relying on anybody else. So you don't, that's like plus number one. And then the other plus is you don't pay any fees. Like if you invest in a fund or a syndication or a REIT, obviously they charge fees. There's a way they have to pay for their staff and overhead, and hopefully at the end of the day make some additional return for all the extra work of bringing the investors along and running the fund or the syndication or the REIT. So, that's, so if you can buy it directly, like you're cutting out any of those fees, you just own it yourself. So there's no asset management fee or acquisition fee or promote that people are charging on the deal, because you just own it. So, but eventually that's going to turn into like a lot of work. So if that's not what you're looking to do, then that's not going to be a fit. We've actually had quite a few people invest in our deals where they've bought one or two properties themselves. They like real estate, but then they realize how much time it is. And they looked at what they were making and thought, okay, I can make basically the same return just investing in your guys' deals, whether that's us or another fund. Like it's not unique to us, but like anybody who's doing this professionally, like we are, we know what we're doing. We have professionals, we have experience, we know the right moves to make, we know the right people to call. We get deals sent to us before others do. We have really good market knowledge and resources here. So then what ends up happening a lot of times, even after deducting the fees, you're sort of paying for yourself. Like the net return on a passive investment, it might be the same return that you might make buying a deal on your own. You're buying your first deal, you're going to make mistakes. It's just not a straight line up on just every deal being super successful. So ideally, if you're trying to, so anyways, that's sort of the thought on the people that maybe buy a couple properties and then switch to be a passive investor. So hopefully that covers everything people wanted to know on that. I know we've had just kind of some people reaching out with different ideas for podcasts, and just wanted to shoot a couple maybe different things that we hadn't talked about. So that's one. So I think that's it. So thanks for joining us. Appreciate everybody listening. Don't forget, if you can leave a rating or review, obviously 5-star. and whatever platform you're listening on. I definitely appreciate it. Help feed those algorithms and other people hear about the podcast. So thanks for joining us, and I'll see you on the next episode.
Thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcasts. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com, where we have numerous free resources and information that can help both active and passive real estate investors. Our 100-plus page passive investing guidebook, our trends report, and our blog are all available on our website. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.